Hey everyone. It has been about 3 years since my very first trade, and I believe I now have enough experience to take a look back and share what would have been useful for me to hear as a beginner, specifically on what it takes to start trading today in 2026. In this video, I will not give you clear-cut solutions, nor will I attempt to persuade you on whether you should or shouldn't get into trading. Instead, I will keep it balanced and give you some things to consider, questions to ask of yourself, and expectations to set. And hopefully, by the end of this, you will be in a better position to make an informed decision and form a clearer picture of what crypto trading is, what it isn't, and what it actually demands, mentally, technically, and personally. I can only speak from experience about algorithmic scalping. Not hodling, not investing, not manual trading, not mining, not staking, not airdrops or arbitrage. All of which are real and valid ways to engage with the crypto space. What I do is scalping, and it has a different flavor and mindset from the rest. Some things will overlap, and some won't. If I were to make the same video back in 2020 or 2021 with the same level of experience and background, it would have likely been significantly different from this one. The expansion and adoption of crypto has evolved massively in the last 5 years, and so has the trading landscape. It is no longer a niche for the few tech-savvy. And while you can't truly call it mainstream yet, the crypto market is definitely more saturated and, dare I say, more mature. There are many more players, big and small. Large hedge funds and investment firms are now heavily invested in crypto, and even some governments. The edge of any single player has gotten way thinner. The simple strategies and patterns that worked perfectly before no longer work. Big players found ways to counteract and exploit the strategies used by smaller traders. There are stories from earlier days where having an algorithmic bot gave you a tremendous edge over the masses of manual traders. You could launch a pretty bare-bones shot algorithm, kick back, and just watch the profits roll in. Not anymore. In addition to more and larger players with deeper pockets, there are now more structural constraints as well. Can you imagine Binance having no quantitative rules for futures, where hundreds of concurrent orders could be running at once without a problem? Or can you imagine not having huge latency spikes every time Bitcoin has a bit of a cough and everyone unleashes their bots all at once? In scalping, volume matters, speed matters, infrastructure matters. In late 2000s and early 2010s, high-frequency trading on the New York Stock Exchange and Nasdaq was all the rage. Telecoms and trading firms spent millions of dollars to shave off just a few milliseconds of latency, and to them, it was more than worth it. They collocated their servers with the exchange or built the fastest possible connection between them. Books have been written about this stuff. And today, pretty much everyone and their mother can get a collocated virtual private server anywhere in the world for like $20 a month. And exchanges have had to adapt to that. As wonderful and ubiquitous as the internet is, it does very little to help you distinguish between what's real and what's narrative. The crypto space has been described across every possible extreme, from total scam to zero effort easy money. You've probably seen ads like foolproof signals for 800% profits, Or titles like, all caps, "No more losses. Just follow this one rule." The only rule to have no more losses is no more trading. And the only publicly advertised signal is the one where it's already too late. I tried major crypto podcasts as well. And every few months, some expert comes along and says Bitcoin will hit 1 million per coin within a year. And everyone goes, "Whoa, what an insight." So far, that hasn't happened. I mean, you can't make this stuff up. Literally, as I was editing the script, another podcast episode popped up predicting now 2 million per Bitcoin. Sure, why not? It might just as well. A lot of it is just content, entertainment, hype, self promotion, and extracting valuable information from all of that is something anyone going into trading will have to deal with. Before starting on your actual trading journey, you may want to evaluate what options are actually available to you. First of all, governments are catching up and introducing crypto regulations in one form or another. So it would help to understand what these regulations are, what exchanges operate in your country or territory, what mechanisms are available for depositing and withdrawing fiat currency, whether there are any asset or market restrictions. Because, for example, in some jurisdictions, certain stablecoins like USDT are restricted or not supported by exchanges. Once you've figured that out, it is time to review the constraints of the chosen exchange. What their KYC process looks like, what their user tiers are and what they allow and what they don't allow, how many sub-accounts are available to you, what the fee and the penalty structure is. Do you have to pay extra for API access? What the limits on trading intensity are, what levels of liquidity are available, and generally what the reputation of this exchange is. This may seem a bit overwhelming, but despite these constraints, the barrier to entry is quite low compared to most traditional domains. You don't need a university degree. You don't need a license. You don't need institutional approval. You can start almost immediately. And that's the key contrast. The barrier to entry is low, but the barrier to consistent success is actually pretty high. Which brings us to knowledge. Ask yourself if you already know or are willing to learn the following. Core trading concepts, such as spot and futures markets, leverage and margin, and where they help and what limitations they impose. The order book, types of orders, the difference between an order and a position, long and short positions, margin type, position mode, how to read a chart or a candlestick diagram. The basic ones are not really that complicated, and exchanges usually have very good materials to learn from. And as you progress, you will naturally move into more in-depth concepts. Next, some technical basics. Unless you restrict yourself to the exchange web interface or mobile app, you need to understand what an application programming interface, or API, is, how public and private keys work, what latency is and what it affects, what is a virtual private server and where to get one, and maybe some basic Linux/Unix commands. You don't have to learn coding, but some general awareness of relevant IT infrastructure concepts will go a long way. Now, in terms of mathematics, you want to be comfortable with percentages, percentage points, and ratios, understand absolute versus relative change, things like return on investment versus return on equity, how and to what extent fees affect your every trade. Nothing beyond high school math is required to start, but as you progress, You may get into things like statistics, probabilities, risk management. You don't have to be a math professor, yet practical application of any math you know is key. You do have to be able to interpret and manipulate the data you encounter. You may also find yourself drawn to different levels of data. You may prefer analyzing market context, macro indicators, trends, narratives, high-level token types, relationships between coins on the same chain, patterns of utility tokens versus meme coins, and you let those guide your day-to-day trading decisions. Or you may be drawn to purely raw mathematical data, focusing on micro patterns and statistics regardless of the underlying asset. Both approaches are valid, though they require somewhat different predispositions. With context, access, and knowledge covered, let's move on to tools. Exchange web interface or mobile apps are poorly suited for algorithmic scalping, which means you'd have to research and select your main third-party tool. And serious tools have serious learning curves. Having a tool does not mean you stop making trading decisions and let the bot do everything for you. No. The purpose of most existing tools is primarily to speed up and automate execution of decisions that you have pre-made within the constraints that you have predetermined. And automation does not mean autonomy. You still have to supervise, adjust, analyze, and make new decisions for the tool to execute. It is also important to set expectations. It is unlikely that with any tool you'd become profitable immediately, not in the first days, weeks, or even months. You can be nominally profitable with small order sizes, but in my case, it took months before I got the courage to consistently set order sizes above 1000 USDT. And even longer than that to step over the 5000 barrier. And this courage is also part of the learning curve. In scalping, the profit margins are usually very small percentage-wise, so it is about volume and consistency rather than single big wins. While you don't have immediate profits, you do have immediate costs. Financial costs include your tool, your infrastructure, your initial deposit, and your ongoing trading fees. Your initial deposit may be small at first while you learn. Doubling or tripling a small deposit is possible, but it requires a level of skill you will likely not have at the beginning. So, you may also want to consider at which point and how much you want to add to shift gears from the learning mode to making enough to recover your running costs and have a profit on top. Also, understand that what works at smaller order sizes is not scalable in a linear fashion due in large part to liquidity constraints. What works with 100 USDT orders will not necessarily work with 5,000 USDT orders. Another cost is your time. Time to learn, time to come up with ideas, time to observe and monitor, time to review and adjust, time to make new decisions, even time to pause and step away for a while so as not to burn out. As I've said, automated does not mean autonomous. So be aware of how much time and money reserves you do have before you need to become profitable.